This just in, China's biggest stockbroker suspends short selling as markets tumble. You're not having a dream right now. Short selling is currently getting banned in China. Here are the details on the story. China's 6.3 trillion stock sell-off is getting uglier by the day. Property sector slump and geopolitical risks are negative. China's valuation discount to India hit a record this week. It's to the point now that don't want to bury the lead here, but short selling getting banned, and they're basically running around trying to figure out how to stop this hemorrhaging. Just in, China's largest brokerage, CITIC Securities, has banned short selling for some clients, according to Bloomberg. This comes as the Shanghai Composite Index, their equivalent to the S&P 500, is having its worst start to the year since 2016. China's stock market is down nearly 25% from its recent highs and 5% year to date. We're talking about this not even at the end of January. We're just over halfway done with January and it's down 5%. That's not good. China's biggest broker curbs short sales after stock rut. Maybe it's not funny. I find it funny because it's the absurdity of just not the US market, but apparently global markets. Get this. The short sell impact, or the short sell ban, is more so impacting retail, as in it's basically impossible if you're in the Chinese markets to be a retail trader to take a short position, even if you think things are going to go down. But guess who can keep shorting? The big guys. How wild is that? That the truly insane setup that we commonly see in the US markets, where the big guys are treated better than the little guys, is actually just a worldwide phenomenon. So, I don't even know what to say about it. How just isn't that ridiculous that they're like, oh no, we'll stop the retail, and then the big guys will do it, but we'll just increase their margin requirements. It's absolutely insane. China's largest brokerage has suspended short selling for some clients in mainland markets amid a deepening rut in the nation's stock. State-owned CITIC Securities has stopped lending stocks to individual investors and raised requirements for institutional clients earlier this week after so-called window guidance from regulators. Chinese shares have extended declines this year with no sign of let-up after harrowing 2023, heading for their worst start to a year since 2016. While it's not immediately clear how many brokerages are restricting short sales, the move signals authorities' eagerness to put a floor under the market after earlier efforts, including state buying of bank shares, failed to lift sentiment. So obviously, if they can't step in and fix it, let's just blame retail? It's comedic. It's absolutely comedic. But anyway, here's what Bloomberg had to say about the banning of short selling in China.
Probably too early to try to see when or where the market will bottom. And yeah, I mean, the economy is still kind of slowly recovering, but I think the confidence has not come back, not only just in the investor side, but also on the private entrepreneur. We have not been seeing the private investment be picking up in China, and that's very important. So
no one wants to do private investment.
Companies, some industry may benefit from the industrial policy tailwind from the government. And investor can still benefit from investing, put some money in those industries. But having said that, I mean, the broad market, I mean, we need a more structural improvement, and we haven't seen that yet.
Compared to the market that is fairly pessimistic about any recovery now in China, I think that's probably gone too far. I think there is possibility that we will see modest fiscal and monetary stimulus through the year, which can provide a floor. But we can't ignore the debt overhang, the property overhang that's going to stay around.
The property sector and the shadow banking is just destroying their economy.
Rates, probably positive growth.
In a couple of years, they're going to have serious talks about population
confidence
collapse.
Investing into China at the moment. I'm seeing it with our global investors for sure. So on one hand side, they're looking into an economy which is doing more or less like it's supposed to, maybe a bit more deflation than what we would have liked. There's some uncertainties around the housing market, that's clear. But I think what everybody's looking for is that policy signal that we're going to see rate cuts, we're going to see more fiscal spending, and ultimately sort of a bit of a bottom under the market. And I guess there was some speculation. We were seeing a little bit of this yesterday with some potential buying and intervention yesterday in the market. So something of a stabilizer. I think that's what we need at the moment.
We have not really been calling for a big stimulus. We don't think they will do it. And actually we don't think they should be.
We know that President Xi Jinping has been specifically against quantitative easing.
That is going to backfire. And also it's not really
I guess giving stimulus that he watched what happened in the U.S. prompts crazy inflation. They're kind of against that.
Transformation of the economy. So I think what we are looking from the government, instead of looking for more candies from the government, we really want to say, can we actually go back to more like what China started in its reform back in early 1980s? Is more allow the private enterprises, entrepreneurs to the right incentive to really to do things, the freedom, and give them incentive, and also give the local government the incentive for growth. And those are actually something probably slow down a bit over the last 1 or 2 years, and that probably need to come back. And we are hopeful on that, but we are not so sure.
I still think China's to be treated with caution. I know it rebounded.
Of course
It's
it
the
is.
most bullish view that we've had from anyone.
All of Wall Street, I shouldn't say all, but so much is like, invest in China, invest in China.
Into the
Dude,
second half
something's
of last
up,
year.
man.
I think the tail risks have receded, but you look at the sequential growth data earlier this week, dropping from 1.5% in Q3 down to 1%. The property market remains in a problematic situation. We did see housing prices drop at the fastest rate since 2015. So the piecemeal stimulus measures just aren't having the desired effect. They have certainly supported the downside risks, but where that upside comes from, that sustainable rebound, it's not clear as yet. And I think that's why investors are going to remain cautious.
They should.
At this point of time, you have to treat bounces like the one we saw yesterday. It may extend for a week or two, but until we see some broader stimulus measures, more effective stimulus measures, you have to treat those rallies, I believe, as short covering rallies.
I think valuations are very, very cheap. So it is interesting to look at upside. We're looking at different structures as way that some of our clients can
just
play
because
that
something's
potential
cheap
surprise.
doesn't mean
but
it
I'd
can't
say
keep selling.
it's still not a market that has a huge weight in sort of a global balanced portfolio, and it doesn't seem to be one where you would really go and increase the risk sort of strongly.
Just to put a bow on this, and maybe this is a little tinfoil hatty, but I think this trajectory and this development is really supporting, like I said, my tinfoil hat theory that I think within the next 10 to 20 years, I don't think that China is going to remain the world's #2 economy. I really don't believe that. I think US will remain supreme just because of our global positioning. But I think what we are seeing is the early steps or the mid-game steps of India becoming the #2. And I actually don't even think China will fall to 3. I think it drops to 4. I think that there's going to be a South American country, maybe Brazil, becoming the #3 individual economy. So some South American country. So basically, I think it goes US, China, some South American country, most likely Brazil, and then we're going to have China at #4. So obviously, feel free to bookmark this if you want, but it is a prediction for about 1 to 2 decades down the line. It's just when you have the banking issues, the shadow banking, when you have the property issues, when you have just as the world is becoming more interconnected and people not really enjoying what the CCP is doing in their own country, you're going to have more just geopolitical dissent. And then on top of that, the really scary thing for China is the way that their population lack of growth is playing out. It's going to become a top-heavy society where most people are of older age and you get population collapse. So I think they're really looking at some serious issues, and that's kind of my thesis of why 10 to 20 years out, I think China falls all the way down to #4 in terms of important global economies.